Well, God bless you, one and all, and welcome back to the Bishop's Corner. And of course, my name is Bishop Dr. Herbert N. Scott, the Chief Prelate of the Liberty Hall Cathedral of Praise, right here in the heart of Brooklyn. We just want to welcome one and all to this our program, the Bishop's Corner. We want to thank God also for the man of God himself, Philip Reed, who is affectionately known as Dr. Phil, and he is the CEO of Phoenix National Business Group. We want to thank God also for the panel that we do have this evening. We have the Reverend Dr. Heather Francis that is with us. Can we make her feel welcome by putting our hands together for her? We thank God for Bishop Dr. Neville Wolliston, all the way from up north. God bless you, man of God. Certainly it is a pleasure. Want to thank God also for Pastor Richard McKenzie Jr. that is with us today. He's from Brooklyn, and you know that good things, great things, wonderful things come from Brooklyn. Next, we have our younger brother, Zan Ingalls, Pastor Zan Ingalls from New Jersey. Man of God, we want to thank you for weighing in. We want to thank God for a beautiful young lady, guest tonight, that she is indeed a wealth advisor, Lori Stye. Can we make her feel welcome? Certainly, Lori, it is a pleasure to have you on the Bishop's Corner. Well, this evening we'll be talking about investing in yourself, investing in yourself through infinite banking. Now, infinite banking is something that I personally know absolutely nothing much about. But thank God we do have a wealth advisor here in the person of Lori, and she will be explaining it to us. So this time we'll be asking the lovely, the delightful Lori Stye to weigh on in. And Lori, please explain to us infinite banking. It's in your hands.
Thank you so much for such a warm and wonderful welcome. I am blessed to be here talking about one of my absolute favorite subjects, which is helping people to understand their money and have it be of a greater benefit to them. I am Lori Stye, and my company is Stye Life and Wealth, and I am a part of SWAT, which is Strategic Wealth Accumulation Tactics. And my goal today in life is to help as many people understand as much as they can about the value of their money. We are a society of people who believes that the only way for us to get by is to pay interest and line the pockets of other people instead of, utilizing our money to grow our own financial legacies. So infinite banking, the concept of infinite banking was created by Nelson Nash in the 1980s. Nash was a finance expert and a follower of the Australian School of Economics, which advocates that the value of goods aren't explicitly the result of traditional economic structures like supply and demand. Rather, individuals value money and goods differently based on their economic status and needs. Out of this thought, Nash developed the idea of individuals becoming their own bankers to better achieve their own unique and financial goals. So infinite banking, that Nash was a very progressive man in his thoughts and how to do things. And if any of you are familiar with these names, Walt Disney, Rockefeller, Berkshire Hathaway, Ray Kroc, he started McDonald's and was the owner of McDonald's. These are the wealthy of the wealthy in our country, and they have managed to maintain and grow that wealth through every economic status in our country for years by utilizing this program. So I am going to go ahead and share my screen with everybody this evening, and we'll dig into kind of the meat and potatoes of what infinite banking really is and what it too can do for you. So let's see. Everybody, is that showing up okay? Somebody give me a cue on that.
Yes.
Yeah, okay, great, thank you. All right, so First Financial Education Centers and Family Bank, which was founded by Larry McLean. He is the person who has, through Church Legacy Ministries and his financial company, partnered with some other companies to finally bring this option or this opportunity to those of us who are, just your average everyday, not Rockefellers. So, but seek ye first the kingdom of God and his righteousness, and all these things shall be added unto you. Matthew 6:33. My people are destroyed for lack of knowledge. Hosea 4:6. Our 7 steps teach to live within your means, get out of all debt, and strategies for predictable, effective, and comfortable retirement. We ask these 2 questions. Are you 100% sure you're going to have a great retirement, or do you have some doubts? What if I could show you how to get out of debt at 9 years or less, including your mortgage, without spending additional money than you're spending right now? The average American household today has a debt of about $250,000, and this is actually a little bit low over this last year with COVID and so many people struggling and utilizing credit to get by. This has gone up. So here is one of the things that I find difficult sometimes to believe, but this is a truth. So you go out every day and you work hard for your money. And the average American household is spending 34 cents of every dollar on interest. And what is interest? Interest is that money you pay to a creditor, to a lender, for the privilege of using their money because for whatever reason, whatever your needs are, you don't have enough of your own. You also spend 40 cents of every dollar on taxes. That's 74 cents of every dollar that you're earning is going out to somebody else. 23%, 23 cents or 23% is our lifestyle. What is your lifestyle? Your lifestyle is your mortgage, the shoes for your kids, the food, the insurance for the car, whatever need it is that you have every day, that is lifestyle. 23 cents. You're working your fingers to the bone. Some people are out there working 2 or 3 jobs. They have kids who are with grandparents or older siblings because it takes so much to support the average American family today, because 23 cents on every dollar in our day and age is not enough. It's just not enough. And we have that handful of people out there who are managing to get 3% into savings. So what if I told you that through this approach, our goal is to first reduce that interest 22% and eventually eliminate it altogether. And by doing so, we automatically lower the taxes, increasing your lifestyle to 33%. Anybody use an extra 10% out of their income, every month or every year to take care of their family or fulfill dreams or goals or put towards retirement? And then the other part is that we are putting more money in your savings, giving you the opportunity to be able to take care of your family in any situation that may come. So knowledge becomes power only when we put it to use. So here is, the great fact. Everybody here, I'm pretty sure you went to school, right? You went to kindergarten and then you went to school for 12 years and you got to your senior year in high school. And in all of that time, Nobody taught us about compound interest. Nobody taught us about a checkbook. They didn't teach us about relationships. They didn't teach us about what it meant to, to get a job and what to do with that money and how to manage that money and what that meant to our families to do so and to our futures. So knowledge is power. So what if we could teach you how to reduce the volume of interest you're paying to your lenders, get out of debt in 9 years or less, improve your cash flow, decrease your taxes, save for college, and retire with a tax-favored income? Anybody played the game of life? Game of life, we start at the beginning. Woohoo, we graduated from high school. We're super excited. We're headed into college. We get this little notice in mail. It's your first credit card. You're so excited. It's coming of age thing to get that little credit card in the mail. But nobody explained to us what that meant. Nobody explained to us that first time we went out and spent $500 that likely we spent because we didn't really have it in a bank account, we're in college or we're young, it would ultimately end up costing us $700, $800, $900 by the time we made the minimum payments on that credit card. That's crazy. That's what they call compound interest. Compounding interest means that the interest is constantly compounding on that balance. And all of these credit accounts and these creditors, they're structured to make sure they get theirs first. They're going to get paid first, right? So we're going through life and we get our first car. We're going to college. Then we're, down the road and we're having children. We're going on vacations, houses, all these things that we go through life and they cost us money. And life is full of ups and downs. We just never know what it's going to bring us. So being prepared and understanding how our money can benefit us is critically important. Because I don't know about any of you, but if any of you in here have ever been so poor that you've eaten ramen or you had to squeeze the last little bit of toothpaste out of the end of the tube, right? That's not what we want for our life. That's not quality. We want our money and the time that we invest in getting that money to work for us. So the average American household, at age 65, most Americans will make $2 million. Remember when you were a kid, you ran around, I want to be a millionaire, I want to be a millionaire, I want to be a millionaire. Well, guess what? If you work a steady job throughout your life, by age 65, the bulk of Americans have made $2 million. So ultimately, we're all millionaires, but what do we have to show for that? Today, the average person at retirement age, at age 65, has $60,000 in retirement. There used to be a time we retired at 62, 64, 65 years old. We had our little nest egg, our retirement, our houses were paid off by then, our kids were grown. We spent a little time with the grandkids. We went out, we fulfilled that bucket list, and then we died. We lived to 68, 69, 70 years old, maybe a little older, but that's how it worked. And so the money was enough. So what's happened? Everything costs more. And today, this retirement wouldn't even last you probably a year or two at the cost of things today. And people are outliving their money. We are living, fully active lives well into 80s and 90s. I have a client who, he's 78 years old, and last weekend he was jumping out of planes. He's skydiving. This is, this is the beauty I get to hear every day. These are the grand stories I get to hear. These are the blessings I get to hear every day. But I also get to see that these same people who are still very much alive and very much full of life and very much active, they're working too, a lot of them, because they've outlived their money. So cash flow, when you track your money, you control it. So part of what we do in the process of helping you with this program is we do a spending planner. We show you where to find inefficient funds, and we're going to teach you, and you're going to hopefully learn for your benefit, how to have a little bit of discipline. Discipline is really, really critical in building the quality of life that we want financially and in every other aspect of our lives. Plan for the unexpected. So not only in here are we going to show you how to develop that tax-free retirement and pay off all those debts and pay off that home in a much more rapid fashion, but we're going to make sure that you have 20% of all of your money saved, set aside in that emergency savings account for that rainy day. Maybe it's not a rainy day. Maybe it's, you go to the, I don't know, if you're a golfer, maybe you go to the pro shop and see that driver you've always wanted. That's the emotional spending, right? Every once in a while, we all need a little emotional spending. Maybe it's a massage, maybe it's a spa weekend, but we all need a little something to know that we have to draw on a rainy day, whatever that rain might be. So the way that banks leverage cash flow is we put money in, we take money out, they give us 1%. 7 times the money that we put in is what they keep. So for every dollar, ultimately in the end, it will cost us 7. This is how banks work. So what if that was how we could make your bank work for you? So what we want to do is minimize debt to create additional wealth. So we're going to take a look here at Mark and Joyce. These are actual clients who are kind enough to allow us to share their case. You'll look at this financial worksheet. It's very simple. It doesn't have any personal information. This is what we'll ask you for when we want to help you do the same thing we're going to show you today. Prospectively, they are 37 and 35 years old. They make about $7,000 a month. They want to retire at 65, like we all do, I'm sure. Their desired monthly retirement is $5,000. They have 3 kids, and they haven't done a whole lot of planning yet. They're still young enough to think about it, but they haven't done a whole lot. So they want to increase their retirement income, reduce their debt, get spending under control, increase their savings, do some college planning, and don't forget your wills and trusts to protect that financial legacy moving forward. Let's see. What happened here? So right now, they are putting $25 a month into an emergency fund. That's awesome. That's really great that they're doing that. However, I don't know where you bank, but I don't know of any banks today who are giving you, if you're getting 1%, stick with that bank. But most banks are not giving, you can see 0.25% interest on their savings. This is not going to help them retire. It's great that they have this emergency fund, but there's more that we could do with this money. They also are putting $300 into a 401k. And again, I'm not going to knock the concept of the 401k. It's a great concept. You get your employer match. However, these are very, very expensive, and I'll show you a little bit later on why. So these are their outstanding debts as reported. And you can see that their interest rates are in here, their current balance, and what their payment is. By the time at the end of the month, when they have paid all these bills, they've put out $2,177. This is money we want to help them now put into their retirement and help them grow wealth through that money. All right, so $180,198. You guys see this? This is the money that they have borrowed. This is this is what they should know, right? But thanks to compound interest, Mark and Joyce's debt is $180,198. This is what we call their real debt. At their current rate, they will be in debt for 30 years. They have a 30-year mortgage. And by the time they're done, based on the way that they're paying for their debt, they will pay $199,959 in interest. Their interest payments will be larger, will be more than the actual money that they've borrowed to provide this lifestyle for themselves and their family. This is the power of compound interest. And, Albert Einstein said, the 8th wonder of the world is compound interest. He who understands it, earns it, and he who doesn't, pays it. And so what I want to show everybody tonight is how to not end up paying your interest into the creditor's pocket to teach you the power of compound interest to your benefit. So imagine earning money on that money that you're paying out, that $180,000. So $36,500 in current retirement savings. They have a $300 a month monthly contribution at a 5% annual rate. They're in a 25% income tax bracket. So currently, at the rate that they are going, assuming the market does not change that 401k at all for 30 years, which is very unlikely, they will have $408,890 before taxes. These are one of the highest taxed accounts out there. So they will, at today's rate, give up 25% right off the top, leaving them $306,668. At the cost of living today, this would not last them, very long. And if they retire at 65 and they live to 95, which is very, very possible, they will run out of money. So let's take a look at what Mark and Joyce were able to accomplish with your family bank. So what did we accomplish? We took that debt, remember, 30 years. They had 30 years because they had a 30-year mortgage, and they had their car, and they had their other debts in there. And we are going to pay off their home in 7.8 years and all of their other debt. They will be debt-free in 7.8 years. And so not only will we be building that tax-free retirement for them with the money that they were before paying into debt and paying into creditors and interest, but we have now made their house a part of their financial legacy, a part of their retirement, and a part of their security because they own it. The bank does not. We've saved them of that $199,000 in interest, $122,739. Just curious, anybody in this room, could you use an extra $122,000 over the next 7.8 years? Because ultimately, this is now money you will not have to pay back. So if you don't have to pay it out, it becomes your money. So we've now increased the value of your financial future by saving you interest. And we've freed up that $2,177 that they're used to paying out that's going mostly to interest. And now it's going to go into a retirement account for them where they will yield compound interest. So now instead of that $408,000, that's a highly taxable amount, in 30 years, they will have over $1 million tax-free dollars for their retirement. So current plan, $306,668 after taxes. And remember, this is under the assumption that over the next 30 years, they don't have some kind of catastrophic emergency that requires them to take a lump out of this, that the market doesn't change and go back to 2008 and take a chunk out of this. There's a lot of variables here that could happen. But in a perfect world, if everything moved forward over the next 30 years, they would have $306,668 after taxes. With this plan, they will have over $1 million of tax-favored retirement. So what is the cost not to do YFB? $104,000 in retirement, $122,739 in interest saved. Total opportunity cost is $820,458, or as I say, non-opportunity cost, because everybody thinks they have a plan today. The thing is that we are very, we live in a world where we have learned to be very in the moment. There was a time where we did eventually learn to balance a checkbook and think about our bills 30, 60, 90 days out. And today, what do? We pick up our phone and we look at our app and we go, okay, I got that much money, I'm good. But that doesn't plan for our future. That doesn't take care of the things that might happen. Nobody expected COVID. We were, everybody was having a great time and they were making money and they all, the jobs were great and sitting around with their families in the summer. And suddenly, we have this pandemic that hits and financially it impacted a lot of people. And if more people had this kind of planning in place, this would have looked very, very different for them. So step 4, taxes. The less money you owe to other people, the less taxes you pay. So once again, we're finding that savings for you to help you increase the value of that hard-earned money that you have every day. So I have a question. What do you think? If you're going to retire in 30 years or even 20 years, what do you think? Do taxes going to be lower, higher, or the same? Personally, I don't think they're going to go down, and I doubt that they'll stay the same, at least probably not for Mark and Joyce, who are looking for, 30 years out to retirement. So if we think taxes are going to be higher, is postponing taxes really a good idea? So what does that mean? What does that mean is if you have a 401k or you're counting on a tax burdened retirement account, and you're not thinking about another way to save or increase your retirement now, imagine 25% today, what that will look like in 10 years or 20 years or 30 years. When should we start tax planning? Now. I have a business proposal for you. You front me all the money. You take all the risk. You manage the business on a day-to-day business, and 30 years from now, I'll tell you how much you owe me. Anybody want that deal? I hope not, because you would not want to go into business with this person. Ultimately, IRAs work very similarly, in a similar fashion to that deal. And this is why we think IRAs are great. Also, I never knock anything that is helping people to put money aside. However, what this looks like is we put 5,000 in, we put another 5 in, we put another 5 in or 10 in, and then it's gone to 20,000. So we now have over a period of 20 years accrued $40,000. However, IRAs are tax savings accounts. So the difference between savings and actual money is that what happens is that $1,250 you see there is saved. It's just money saved that you didn't have to pay, right? You didn't have to pay it on that $5,000, that 25%, or which is that tax bracket. So that saved money gets spent. It's not like it's in a bank account waiting for you to be able to pay the taxes when the time comes. It's just out there saved. And again, the 2,500, the 5,000, and then the 10,000. So when this account matures at 66 and you're thinking you have $40,000 in it and you've got all this tax savings along the way, you still have to now pay the $10,000. So now where is the tax savings? So let's take a closer look at a comparison of tax deferred, and tax-free. You have $10,000 investment, 28 years, 7% interest at a 25% interest rate. The tax-free version would be $66,488. Anybody want that? That would be me. I want that one. Or you could take $49,866, or you could go with these high taxed retirement accounts and end up with $41,900 of your hard-earned money. While $66,488 could be yours if you look at alternatives to what to do with your money, which is what we're providing you today. So don't lose a lifetime of work. What are your potential risks? Taxes, market, inflation, emergencies, disability, lawsuit, fraud, outliving your money, and death. These are the risks. This is what threatens your current, most people's current vehicle of retirement or vehicles of retirement. So what if I told you that this vehicle has is tax-free? It is 100% protected from the market. It cannot be impacted by inflation. It builds in a 20% emergency account. It protects you in a situation of disability. It cannot be attached by any type of legal lawsuit against you or family. It cannot be defrauded, is it's held, and I'll explain to you why, but it's held in a very special account, and it allows you to potentially put in enough money in place so you don't outlive your money and you can have a quality of life. The one guarantee that we do have is eventually we will die, but what we want to do is enjoy what we've worked for right up until that time comes.
Amen to that.
The big picture. Know where you are going and how to get there. 3 phases of retirement: maximization, accumulation, and distribution. This is what the big picture plan benefits. Argue less about money, find wasted money, improve cash flow, dramatically increase your savings, get out of debt faster than you ever thought possible, learn how to prioritize your accounts, and retire with a tax-favored income. One of the things that I love about this is one word: guaranteed. There aren't very many guarantees out there, but inside of this, there is a guaranteed growth and there is a guaranteed tax-free retirement awaiting you. So Mark and Joyce's before: $180,198, $380,157 in real debt, with a 30 years, $199,959 just in interest. That means that you're paying your bills every day. You're going and you're working your fingers to the bone. You're paying your bills. When you pay that bill, that creditor's eating lobster while you eat ramen to get out of debt. How many of you want to eat lobster every day?
At least every other day.
Every other day.
So once again, free from lenders, all lenders in 7.8 years, saved interest $122,739, freed up $2,177 to go into their retirement, and will retire with over $1 million. Now, most people see this and immediately make decision to be like Mark and Joyce. Would that include you? So let's review. Step 1, knowledge. Step 2, improve your cash flow. And step 3, reduce debt. Step 4, reduce your taxes and minimize risk. And step 6 is the big picture. Your decision, a goal without a plan, is just a wish. Anything that is real in our lives takes action. So this is your opportunity to take action and do something different. So we gather your info for a data sheet. We analyze your data, run reports with your numbers. We schedule what we call your big picture report meeting. And in that big picture is a professional financial roadmap that'll show you that with discipline and maybe with a little bit of sacrifice now, you can have so much more for you and your family moving forward.
Okay, well done indeed, Lori. Thank you very, very much for that in-depth explanation. I just want to ask 2 questions, and then I'll let Dr. Heather ask hers, and then the gentleman can follow suit after. A person not seeing this illustration want to know how they can pay off their debt in 9 years, as you said. Okay, they want an explanation, as simple as possible. Okay, I want to know that. I want to see that. And my second question is this. I find today that financial literacy is very much important, especially how to handle money. Why, in your estimation, now I'm just picking your brain, why is this not taught in kindergarten, junior high, or even high school? Why don't they start early? Now, just those 2 questions. Now, I'm picking your brain, and I'm asking that for a reason. So I'm expecting an answer. It's in your corner, my dear.
Well, the first question, what I'm hearing the first question to be is, without seeing this presentation, if you were to want to share this with somebody, and this is what I say, is money is very personal to us. It's we work hard for it. It's very personal. It takes care of our families. And when people are interested in understanding this better without getting to see this, this particular presentation, what I say to them is, look, I have this form and I would like you to just fill it out. It doesn't ask you for personal information, but I just like you to fill it out and give me the opportunity to show you exactly how this would work for you personally. Because I could sit here and I could put up a financial roadmap for our guests this evening, and it would be powerful, but it's never going to be as powerful as seeing your own home paid off in 7.8 years. So that would be, and I love to have this conversation. Call me and I will do these for people individually all day long. So there's that. And the second question I'm going to answer with a question. Why do we learn about the isosceles triangle in the Roman Empire?
Why?
That's what we learn about.
Yes,
okay,
we do.
Raise the hands. If everybody was on this screen right now, raise the hands. How many of you have used the isosceles triangle in the Roman Empire since you got out of school?
I use it every day.
But money is such an important thing. Wouldn't you think that it should be taught, especially how to use it, how to invest?
Absolutely. And that's why I share in this thing that we do. We go through school. We go through thousands of hours of school. And then we're 18 years old. We've done 12 years of school. And honestly, I think that school, the benefit of the first 12 years of school is more about learning the discipline and the daily, getting up and showing up for something daily. I think that we do not share or spend enough of that time preparing. We need to be preparing people for life.
Amen to that.
Okay, great. You gave me home ec and you gave me a doll so I could learn how to change a diaper. But that diaper and that doll isn't going to mean anything if I don't understand my money and how to take care of that, that baby, right? But we don't. We still don't. We have these we've been having these conversations for years, and we still have kids who don't. Look, we had this conversation, I believe, the other day. You line up 100 kids under 10 right now in front of me, and I bet you there'll only be maybe one or two who can read an analog clock. There might be 5 who can tie their shoes and their laces because they all use Velcro now. Okay. So not only did we in the past not teach people about money, but now we're dumbing everything else down.
Right.
What are we doing to our future societies and our children? But I agree with you.
I think that's.
And I've never used the isosceles triangle and the Roman Empire in my adult life.
I think that's interesting because as someone who was a teacher, we teach the kids to count money, but we don't take the time to teach them to value money and to respect money.
Yes. And that's not by any fault other than, we're still following a path of how to do things for a long time. And at some point, like so many other things, somebody is going to have to, hopefully one day say, wait a minute, what does this mean? You're 17 years old, you're about to get that first little, $300. Anybody got? You were 17, you're headed to college, you got that first $300 credit card offer in the mail. You were all excited because it meant you were grown up. And then you're 25 years old and you're still paying on the first thing you bought on it. Now it's a $1,500 credit card. And they will keep raising your balance. They'll keep raising your credit line as long as you make that payment, because for them, you're just a cash cow.
Yeah.
They're continuing to eat lobster while you're eating ramen, and you're paying 18% to your principal, and the rest is going to interest.
Gotcha.
So here we learn about compound interest so we can earn it instead of paying it.
Okay. Dr. Heather?
Well, good evening, everyone. This is an awesome conversation. Thank you to PNBG, our Dr. Phil, for allowing us to have this platform. Good evening, Bishop Scott, who is always doing an excellent job. The esteemed panel and our fill-in tonight, Pastor Zan, thank you for coming on. And especially to our special guest tonight, Lori Stye, thank you. You are a wealth of information. Great information. And as we all know, you are your greatest asset. And you investing in yourself is the most powerful thing you do. Also, we do realize that the younger you is responsible for taking care of the older you when you get there.
Amen.
And that's what it is. This is a great conversation to have because it's not just looking at where you are now, but where you're going. And so you have to think, how can I take care of myself 20 years from now, 30 years from now? And that's something that, as some of my cohorts have already said, no one teaches you that. And so my question is this, based on the product that was presented tonight, how quickly after purchasing the product can you actually acquire funds to, number one, clear your debt, number two, get rid of your mortgage, and number three, do some type of college planning? Is it something that once you purchase the product, you will begin to acquire wealth so that you can, let's say, 6 months from now, you can acquire a lump sum so that you can be the process of doing that? Or is there a time period where you have to wait, say, 5 years, 10 years before you can begin to do that? What exactly is the timeline?
That's a super big question. So let me start. First of all, we are creating a bank, your bank. The only difference is that instead of being the banker, you're paying interest to your earning interest. Okay. So there are no time waiting periods. You have full control over how you use your bank. That's why we talk about discipline and learning to be disciplined in this, because you are putting the money in. And if you have goals for that money as you're putting it in, it's really important to be disciplined as it builds so that it can be utilized for what it is that you're trying to achieve. On an average, we help people pay off most consumer debt in 18 to 36 months. That would be your credit cards, your cars, your student loans, blah, blah, blah. Okay. Then the home comes further down the line. The question is to how much or how quickly you have money that you can take out in lump sums. All has to do with the commitment, the initial commitment. Because remember that 2177 that they were freeing up? We are going to start this account by helping the client to find what we refer to as inefficient funds. That's why we say help you pay it off without spending any more than you are now. Because there are other monies. Even people who say, I have no extra money. I guarantee you, on average, I can find $300 a month somebody's spending on Starbucks and dinners out and cable. And the question is, are you willing to give those things up for 2 years to have more financial freedom moving forward? Or do you want to stay stuck here for the next 20 years of your life? So that, so ultimately we are looking for an amount that you can afford to put into that monthly that helps you build that bank so that you can start taking loans out to pay off that stuff. When you're taking money out of your bank, this is the infinite part. Remember, infinite, the circle never breaks, right? The infinite part is when you are borrowing money out of your bank to pay off a debt, your bank still sees that money there. So you're growing interest on money that you're using. Now, as to how quickly and how much you can take it out, these are custom built. So we have to determine, are you going to put $300 a month in to start? Are you going to put $1,000 a month in to start? Are you going to put $25,000? We do have people who do that, businesses who put these large lump sums and utilize this to help pay their monthly business costs. Whatever that number is, as we pay off those debts, right? As we pay off that first credit card that's got a $25 payment, and we pay off that second debt that has $75 payment, we're going to take those payments and put them on top of whatever that initial commitment is. So if that commitment was $500, the first thing gets paid off. Now it's going to be $525, and the second thing, and that's how we take that $2177 in Mark and Joyce's case, and we are now putting it into the retirement fund. Keep in mind, unlike other retirement funds, though, this is your bank. You have full control. If you have an emergency, if you have something, there are no limits or penalties to money going in and out of this thing. You get to take your money if you need it. So, and you can also open them with large lump sums, which would allow you a bigger sum to take out. So I know this is a very complex answer, but ultimately these are very customized and have so many different ways that we can create them, where they're annual payments, monthly payments, where they're utilized to create larger sums of compound interest by pulling all your money out and then using that money to pay it back. I mean, there are so many different ways that we can help people to build these into really significant financial changes in their life with money they're already using.
Mm-hmm. Gotcha. Question, gentlemen?
Yeah, Laurie, thank you so much for spending time with us tonight. This is definitely very helpful, especially for us as leaders, as pastors, sharing this information with our parishioners. So we really appreciate you coming on. I have just maybe two quick questions. I know my counterparts have questions also. So question number one, this is all good. I get the big picture, but what if I don't have time? What if someone don't have time? I'm 65 or 7 years old. How would that work in my benefit? How would that benefit me?
Well, so a great example. Okay, so let's just say this. You're not going to put obviously $1 million in place for retirement, right? Like Mark and Joyce, because they're 39 and 7 years old, whatever they were. However, if you either have a retirement account that is either going to be costly for you or is not having the benefit, we utilize that as a lump sum payment, which helps you start growing that right away. We also have, like today, I just discussed with somebody about utilizing their Social Security. So you have to remember that when you're putting your money into this, you're not getting rid of your money. It's not going somewhere where you don't have access to it. So you're not going to get like $1 million out of this if you're 61 or 65 or 68 years old, but we do utilize these to help people who are closer to retirement or at retirement age to at least eliminate more quickly what they have so that they're not paying out those debts. And a lot of them still have mortgages. So, instead of leaving those mortgages behind for their families, we are also providing them the opportunity to be able to put that into their financial legacy. So, obviously you're going to have a lot less growth, but you have probably some other options on how to grow this. I want to say this because I haven't said it, and I just want to make it clear if people have not picked up on this. This product runs through life insurance. That's why it is so protected. So no life insurance company's ever gone out of business. And they, by doing so, we are taking that dollar. So I just want you to imagine going to Starbucks with a $5 bill, you drive through, you hand it to the lady, and that $5 will never do anything for you again. It's gone. It won't help you ever again. You got a cup of coffee. Imagine that $5 working for you multiple ways. Imagine that $5 compounding interest. Imagine that $5 protecting your family through a life policy in the event that something should happen to you, and a critical illness policy in the event that you should get sick in the meantime, so that they don't have to pull out of their pockets to take care of you. And it's also growing that retirement and helping you pay off things more quickly. So to answer your question, is there are, as again, so many ways to build this, but what I say is, if your money can do more for you, whether you're 69 or you're 39, why would you not want it to, no matter how little you have?
Gotcha. Thank you so much.
And Lori, it's so important that parents also open, these things up for their children and so forth. And that's the reason why I ask, why is not this taught even in junior high or even high school and so forth? Definitely important, because the thing is, like, when they become 40, 50, 60 years of age, come on, compound interest. I think it's so important. Okay, questions, gentlemen?
It is critically important.
Yeah.
Most people are skeptical when you talk about their money, and as Bishop alluded to earlier, one, because it's not taught, and now they are teaching algebra in kindergarten. All right, so the concept of waiting until they get older, it doesn't have to be that way. We can start with the very simple foundations and start teaching this. So because I wasn't taught this in kindergarten, and most of us on the line was not taught this in kindergarten, first grade, second grade, third grade, fourth grade, on up the line, what can you do to kind of ease the anxiety? Because I think this is very good information. And for the last couple of weeks, we've been talking about investments. And for a lot of people, it's the first time that they're hearing the concept. And so we're being inundated with a lot of good information, but at the same time, because it's new, it can be kind of overwhelming. It can be kind of scary if you're talking about, all this stuff, and I'm, people sitting there talking about, okay, and the first thing we got to get them over is that, I'm glad you said it's not too late to do something, because now a lot of people could be saying, wow, I wasted all this time. Why didn't they tell me this in kindergarten? All right, so what can you do to kind of ease the skepticism and ease the anxiety?
Well, first of all, absolutely no offense meant by this, but I am not God. And so appeasing anybody's anxiety or concern, especially about their money, is not in my wheelhouse. However, because we're all human, and I have been self-employed 40 years, and everything that I've ever done has had to do with people's money, taxes, signing them in and out of homes. I've been a tax preparer of 38 years. So this kind of thing, and helping small businesses understand how to get out from the black to the, from the red to the black. I mean, so money is very, very personal. It's the dirtiest thing on the planet, and yet we have a super intimate relationship with it, and it causes a lot of fear and anxiety. You're right, on so many levels, right? What do we do with it when we have too much of it? What do we do with it? What do we do when we don't have enough of it? And so what I say to people is, the beauty about this thing, first of all, is it sounds too good to be true, but it's not. And I understand that. The other side of that is that because of the way that this is and the way that this is structured, first of all, nobody here is ever going to pay me a dime. Okay. So to understand this and get one-on-one with me and fill out your data sheet and get your financial roadmap, that is a completely free opportunity without providing me any of your personal information. I don't want your social security number, your account numbers. I need your birth date. That's about it. Most people have that on their Facebook, so I think we're all good on that one. But the only way really in this particular situation that I can honestly first validate how people feel, because I get it, we all get it. But second is to tell you that you have the opportunity to take a look at this and how it impacts you personally, your dollar, what you make, your situation, without having to have any financial investment in it. It's a matter of, most people can fill that form out in about 20 minutes. They send it on over to me. I spend a couple hours and I build them a financial roadmap. I get on here with them. I go through it with them. I explain it, and I spend as much time as they need to understand it, to answer their questions, to help them do a spending planner, to figure out how they could best have it benefit them. And my hope is that by the time that I've walked them through that I have established a relationship of trust with them, because that is what I do every day with people, I hope.
Gotcha.
That's my best answer.
Well, that's good. And I think the fact that you have leaders here on this particular station, we have a group of people that follow us weekly. And because of the fact that Bishop has given you his blessings by letting you appear on the program, that's going to give credence to, or validity to, what you're doing. And so I just want to say, and then I'll be quiet so someone else. I just want to say we have to open up our thinking, because the only thing that we've been taught to do, you just blew a hole in it, you know, such as a checking account and a savings account. That's all we've ever been taught to do. So which means that if we want something new, people that are listening to us, you got to start thinking differently. And these programs that have been aired for the last couple of weeks, it's challenging us to think in a different way, a broader perspective. But each of these ways that we've heard is going to be beneficial in the long run. Amen. So that's just my nugget.
Yeah, and let me just say to you that I really appreciate what you're saying about the kids. The other thing about this is you know, you brought up doing these for kids when they're younger. It's not exactly this same product, but right. We can do these for kids. Imagine putting a policy of type in place that not only protects your child, but that has a small cash growth based on what you're putting into it over the years, that gives them something down the road. But if any of you are you know, in your 50s or 60s, or you know, and you've tried to insure yourself to make sure that your family is protected from having the cost, you know, and I'll just say it, death is expensive. And it's not expensive for you because you're gone, but it's expensive for who you leave behind.
Oh man.
So that's kind of the whole point. But imagine being, you know, that child who had the smart parents or the educated parents, and put that in play for them when they were 5 or 6 years old, or 5 or 6 months old, or even 9 years old. Yeah. And they are 30 years old and they're paying $25 a month for the rest of their life. It will never go up. And they have their protection in place. And they have this small bank account of their own, tax-free, protected, growing as well. Mm-hmm. So that's just something else to throw in that. But educating children today, if you're out there and you're talking to kids, yes, please make sure that they understand that the isosceles triangle is not going to pay their bills.
Amen to that.
All right. I have a question. First and foremost, thank you, Lori, Bishop Scott, the entire panel. Dr. Phil, God bless you. Lori, you mentioned that we wouldn't have to pay you a dime. God bless you. I appreciate that. But there has to be some type of cost factor into coming into a program of this magnitude, because I don't believe that your company just runs on hallelujahs and amen. So there has to be a cost factor. And with that, who would be eligible?
All right, so that's a great question. So first question, the reason that I don't get paid is because this is something we're running through a type of insurance policy. So I'm paid by the company, and I am paid by the total. I got into this level of the financial services because of this product, because of all these years of working with people and their taxes and their homes and their small business finances, and just saw the power of how many people I could help get over that hump of, living day to day and week to paycheck, living on dreams instead of realities, living on dreams instead of, something fulfilled that they could do for their families and themselves. So this is the reason that I love to do this, is that opportunity. So I'm paid by the company once I help somebody do that. Okay. And then I don't leave you. I become your financial consultant. I'm here for you for the long term as you utilize this thing and, have questions about it. So it's not something where I'm just saying, okay, yep, great, here you go. Have fun. So you do continue to get me moving forward, and I don't take a percentage of what you're earning. That's the blessing. And of course, the blessing is getting to help people. So on that side, second question is, who qualifies? You do need to qualify for this product based on your health. Okay. However, we have 3 different companies we work with that all have kind of different parameters. So I have not been unsuccessful yet in finding coverage for anybody so far. But the beautiful thing about this is that if you do have some type of illness, or you have some kind of situation, God forbid, you have cancer or something that would preclude you from qualifying for this, it does not mean that your children, grandchildren, spouse, friend, or whatever wouldn't qualify for it. So you can have somebody else qualify for you.
Okay, Lori, do me a favor, please. Would you please explain to us the guaranteed interest and how that is compounded, by giving us an example? Because I'm sure that people would like to hear, if they have say 10,000 and the guaranteed interest is 4.25, is it? Something like that. And the compounding of that, how that multiplies, because that's what we like to hear. Because we put a penny in, we want to get 2 pennies out.
Do you guys know that concept about if you double a penny every day for 10 years, for 10 days, and if you double the penny every day for 20 days, and if you double the penny every day for 30 days, that you would have $10,000, right? Sure. That's what compound interest is you have a penny, you add a penny. The next day you double 2 pennies, you double 4 pennies, you double 8 pennies. That's how compound interest works. Okay. So when you go and buy a car, and this is the easiest way for me to kind of explain it. You go and buy a car, you have an interest rate of 5%. And as you pay the principal down on the car, right, your payment potentially might go down if you pay a little extra, right? If you pay a little extra, your payment might go down. And the reason that goes down is because your interest is compounding less as your principal goes down, right? So what that means on your side is that you put $1,000 in here and it's compounding on $1,000. Well, the compounded interest on $1,000. So the money that you earn, whatever that is, let's say that's $50. So now the next day or the next quarter or, the next month, it's going to compound on $1,050. And then you get some more interest, and now it's going to compound on that plus that interest. So everything that grows in there collects interest on as well. The other thing that makes this thing so beneficial or grow so quickly is because it's your bank and it's infinite, right? If you take a loan out, your bank still sees that money there. So even when you're utilizing your money, when you're using your money to pay off that first credit card or that car, your bank still sees it. So you're still getting your interest on your money when you're using it.
Although you've taken it out, you've borrowed it.
Mm-hmm.
And that's something that we should get over to the people.
Right. And the floor, we call that the floor, the 4.25. What that means is guaranteed, no matter what the market does. The whole thing could crash tomorrow and you were going to get 4.25%. If the market is great and up, even though this is not controlled by the market, it still can, the insurance company can still earn from the market, then you can potentially get more.
Mm-hmm. This leads me
to imagine having your retirement someplace that can't be impacted by the market. If you get sued, they can't touch it.
Mm.
Right? I mean, I hate to say it, that, but these days, people like other people's money more than their own. So if we're in any type of business where we engage with a human being on the face of this planet, we're at risk, right? That somebody's going to get mad.
Mm. Then, Lori, let me just ask my last question and then I'll shut up, I promise. What then would you say are the advantages versus the disadvantages of infinite banking?
Well, the advantages are guaranteed. The advantages are protected. The advantages are utilizing your dollar more than once. Saving, being able to have more of your money for yourself instead of paying that into taxes. I mean, the disadvantage to me is the discipline. And I don't see it as a disadvantage. It's just that, unfortunately, we don't have a lot of people just don't have a lot of discipline these days. And it's not a bad non-discipline thing. Like I said, we have societal norms now, and they are not very few of them are around how to manage money.
Mm-hmm.
We're not taught it, and now we have these crazy little, objects of distraction, as some of my friends call them, and they tell us all we need to know in a given moment. So we're very we're instant gratification these days instead of long-term planning.
Mm-hmm. Then, Lori, let me ask my final question is this. Then what would you say are some of the questions that we should ask before going in or getting into infinite banking? Besides age now, besides age.
What are the questions that we ask that we need to answer before we help you get into infinite banking? That's correct. Mm-hmm. Okay. So age, health, age, health, overall health. So height, weight, medications, existing things that, may. But one of the beautiful things about this particular product, and if any of you have ever gone out and got like just regular life insurance, everyday life insurance, they ask you these questions, and based on that, they say $100,000 is this much money. That's it, right? This is designed as a bank with that as a benefit, right? So it doesn't matter Really, I mean, it does matter, but if your insurance would normally be more expensive because of health, all that means in here is not that it costs you more, it's just that you get a little bit less insurance.
Hmm.
But the insurance is increasing, so it's always getting bigger.
Okay. Questions?
Lori, in regards to the personal home property, paying that down in 7 to 8 years or 9 years, can that work for, let's say, commercial or for like a ministry?
Yeah, we do this for businesses all the time. Yeah.
Churches?
Yeah.
Oh, okay. That's good to hear.
Can I answer a question in the chat
Sure.
to Paulette?
Sure.
Paulette, if you're still on here, the reason that you would want the benefit to paying off your home and not having the interest on your taxes at the end of the year as a tax preparer is because our standard deduction now is so high that about 80% of the time, and this is only for, unless you have multiple homes with high interest rates or high interest payments or very big mortgages, your interest no longer has any impact on your tax return.
It is so true.
It would be better off to pay off the home and have that financial asset for you as a legacy for your family. It becomes an asset. It becomes something that protects you. Because one of the things that we talk about in the life insurance world is that homes that have a mortgage on them need to be protected in the event that somebody who is helping pay for that, something happens to them, because it's not just about a family becoming homeless. Once again, learning about our money, our homes build equity. That equity is our sweat, right? We go out, we work super hard, and we pay these payments on this home, and the home gets value, and the principal goes down, and that's what we call equity. And that equity is our hard-earned money. That's our value in that asset. And if something happens to you and you lose it, the bank doesn't go, oh, we're taking the house, but here's your equity. They take it all. So we want to make sure that we protect that. So if the home is your asset and the bank has no, they don't have any rights to it, then there's a lot of benefit in that. And then, so that's that. I want just to answer that.
Just a quick question, Lori.
Very common question.
Mr. Nash, who started this, Nelson Nash, is he alive still?
No.
He died now.
No.
Who was this program designed for originally?
What do you mean? Who was this program designed for, as far as to utilize?
Yes.
The Rockefellers, Walt Disney, Berkshire
the rich and famous.
Well, not just the rich and the famous, but those are like the elite. We talk about the 1%, 10% have 90% of the money and so forth. This is the 1% of the elite money in our country. And so that's who this was initially designed for. And that is, if you were to actually go back and research some of these people in the economic downturns of the last 60 years, they actually grew their money exponentially during that time because of this.
I have a question. It appears that this is like a wealth of money that is kind of out there, like I would say the cloud. I'm trying to comprehend this whole product, that it appears to me, and you can tell me if I'm wrong, that this is almost like the cloud, that this money is just there. And as you purchase the product, tell me if I'm wrong, this is only whole life as opposed to smart universal life and universal life, because some are affected by the market, because you did start off in your presentation saying that this particular product would not be affected by the market, which means it's a whole life policy. And if so, is that how they're able to be the company itself or the backing of this banking, how they're able to allow you the flexibility of being able to tap into this resource so early on when you get into purchasing this product? Or am I thinking right? Or please tell me if I'm my way of pattern of thought is correct, because I just need clarity on that, because that's kind of where I'm thinking that there's this wealth of money, and once you buy into the product, because it is whole life and it doesn't affect the back end or the value of the policy, that you can tap into this resource and get X amount of dollars from the onset of the approval based on the criteria or the variables. And that's how you're able to, pay off the debt, take care of the college, pay off the mortgages. And then as time goes on, you can continue to pay this off. Because in a normal whole life policy, this almost seems too good to be true. So help me to understand with my train of thought. Please make it like A, B, C, and 1, 2, 3.
Okay, super simple. Okay, you go out, you buy yourself a whole life policy. They do your health thing. You say, I want $100,000. They tell you that's $400 a month. That $400 you're paying is for $100,000 of insurance.
Right.
Whole life policies just so happen, because of the nature of the policy and that you pay a little more than term, build this small cash value inside them, right? So you're getting this cash value that helps you out along the way, and it builds, and it's not real big. But that's just a benefit. That is a side note of the whole life policy. This is the opposite. Whatever you're putting into it, 70% is going to your bank to grow, and a small percentage of that is going to keep a life policy inside of it. So it's whole life on steroids.
Paying for $100,000 policy, but you're keeping 70% of your monthly payment that you're putting in. But then you're saying that you can still, once you qualify for this policy, I can call up and say, let's say it's Lori. I purchased my policy last month, Lori. I would like to get a lump sum of, say, I purchased a $100,000 policy. I need $50,000 to pay off all my debt. Is that possible? I call you 30 days from today. Is that realistic?
No, because your $100,000, the $100,000 you're referring to is your life benefit. That's your death benefit. That's your life insurance.
Okay.
The other amount of money, the other 70% that you're putting into this, right? 65 to 70% that's going into the actual bank, which is the cash, that takes time to accrue. So let's say you came in and you said, I want to take my retirement account. I got $50,000 and I'm going to put this in here as a initial payment. And then I'm going to pay $1,000 a month moving forward. We have people do that all the time. That you could do as soon as that policy is issued, pretty much the next day, you could go in and take your 60% of that 50,000 right out right then.
Okay. All right. So I'm getting it. So basically, I can only take out some of what I put in.
Well, yeah. Well, but also what's compounding, because remember, it's growing rapidly.
But that's going to take time for me to be able to extract and do what needs to be done over time. The college, the mortgage, the debt, that's going to take some period of time.
Right. Well, that's why we can't pay off your house tomorrow. We have to wait 7 years instead of 30.
Okay. Now, all right. The light bulb is going off.
And that's one of the reasons that
but 7 is better than 30.
Yes.
Oh, sure. Of course. And that's the reason why we want to start this thing or expose our young ones to this at an early age. It is so important, definitely, because at least, I mean, by the time they are 30, 40 years of age, they'll have something substantial. And that's important. Yeah. And I think that this is something that should be taught in the schools. Don't wait until they start college. I'm being honest with you, because now that we're hearing this, most of us would be saying we should have done this some years ago. But some years ago, we didn't hear about infinite banking. This is something I'm hearing about this month. Where have I been?
Here.
Where have I been? Or better still, Laura, where have you been all this time?
So I have a question.
Here I am. Philip found me. The blessing that he is.
Quick question. So Lori, initially you said you come to us, or we come to you, you establish this plan where you see all of our outstanding debts and how we can, all right, that's great. Now, what happens to that plan as more debt is accrued? Is there somebody that's going to say, hey, let's get back together, let's readjust this plan, or are we supposed to use that discipline that you spoke about earlier? Go ahead.
That would be me. That's why I said, I don't just like build one of these, tell you, yep, this is what you can afford. Here you go. You're all set. It's issued. Have a nice day. So let's say you start one of these and you have a card, a credit card, and well, I don't know, a furniture loan, excuse me. Mm-hmm. And those are your first three debts heading towards your mortgage. And at some point, this hasn't accrued enough for you to make a purchase, and you go buy your wife another car. Go buy another car.
Yeah.
You would just call me up and say, hey, we did this. We want to add this in. And, I will just rerun all that for you and show you, what it'll do, what'll happen. And then I get people who have done this too. Don't do this. If you get one of these, do not do this. You have one of these and it's structured to help you pay off your debt. But the idea is to earn interest on your money before you use it to pay off the debt. Remember, we want the dollar to work twice, not once. Mm-hmm. So I get people who will get a tax return and they go pay off a credit card. No. You put that money in here. Let it grow, and then take it out and pay the credit card, right? Because then that money is more than it initially was. We always want everything to be a little bit more than initially it is. That's the idea.
Okay, we have approximately 5 minutes left. There is 6 of us that's on the panel tonight. Okay, Reverend Dr. Heather Francis, with all that's been said, what should we take away from this conversation?
I would say that savings alone is not enough for you to achieve financial freedom, but ensuring your asset, which is you, who are your greatest asset, with insurance is equally as important as savings.
Okay, Bishop Dr. Neville Wolliston, man of God, what should we take away from what we've heard?
Yeah, 2 things, Bishop. Knowledge is power. What you don't know can hurt you.
What you don't know can definitely hurt you. Okay, Pastor Richard McKenzie, man of God, what should we take away from this conversation tonight?
That we should be teaching our children these things and starting them from a young age so that they can be more financially secure as they continue to grow.
I agree with you, young man. I'll applaud you. Thank you much. Okay, Pastor Zan, with all that we have heard, what should we take away from this conversation?
I think we should take away that we should be open-minded and trying new things. Don't be afraid to learn, ask questions, and we want to make sure that our families are taken care of.
That's so important. We just want to thank God for Lori Stye that's with us tonight. A wealth of knowledge. Woman of God, you have said so much. You've taken us from zero to all the way up there, hero. Okay, you have deposited so much in us. Your last and final words to us, please.
I would just say that if you are here and you have any other questions, I believe that there's contact information, or I can provide it. I am more than happy to have one-on-one conversations with anybody who wants more information, wants to understand more. As I said, this is not a job for me. This is a passion. So that I can help people to learn more, to learn the things we didn't learn. And I just want to tell everybody, it's not too late. It's never too late to take a look at what the options are for you to help you, expand and create opportunity with your hard-earned dollar. Because I'll tell you what, some of us get to go out and do what we love every day. Not everybody gets to do that. And, money is personal, it is intimate, and it is hard to make. And so when we do make it, whether we love it or don't love it, make it be its best value to you.
And that's why we need the infinite banking. Okay.
Amen.
Well, listen, we just want to thank you, Lori, for weighing in tonight. Thank God also for the Reverend Dr. Heather Francis, Bishop Neville Wolliston, Pastor Mackenzie, and our Pastor Zan. And also we want to thank God for Philip Reed and so forth. Lori said something in the beginning that's very, very interesting. It's something that I'll always remember. A goal without a plan is just a wish. A goal without a plan is just a wish. This is
sometimes a death wish.
Thank you. This is Bishop Scott saying, God bless you one and all. Thank you for weighing in to the Bishop's Corner, and all being well. We will see you next week. Same time, same channel. God bless you. See you then. Bye-bye now. Stay there.